Wow. I love it. I love it. I love it. That is my new intro. My people. Where are my people this morning? All right. But that's my new intro. And I'm just waiting for my people to come in. So I would like to welcome everyone to the Commercial Multifamily Masterminds. We are a member of the GOB network of apartment investors. So the GOB mission. The GOB network seeks to democratize commercial real estate via mentoring and deal making by providing the resources to close investment properties and improve returns. In other words, the GOB mission itself is an educationally based platform that provides network and support to assist those investors to help them get them deals across the finish line. Now, in the Commercial Multifamily Mastermind, our mission is to get rid of that competitive mindset and to have the mastermind mindset. It is here where we would do everything in our power to assist you in getting your investment opportunity across the finish line. We have investors of all levels here. You have new investors, seasoned, you have GPs, LPs, you have sponsors, you have all levels of investors here. So welcome to the Commercial Multifamily Masterminds. And again, we're a member of the GOB network. The mastermind principle is the coordination of knowledge and effort of two or more people who work towards a definite purpose in the spirit of harmony. I would like to introduce the creator, and let me open that up, Mr. Jim Bates.
So I think most everyone knows that that we started the GOB network as a member-driven platform to help people get more deals done. Whether you're a new investor that has no clue how to get started, or whether you're a seasoned investor and are just looking for more net worth or liquidity or other pieces that you might be missing from your team. And as an example of that, we are sponsoring a 134 unit deal in Houston with members of the GOB and that are all on the platform in Houston. It is a 506c for accredited investors only, but that's an example of a few guys that started their company. They're all Navy officers, and came to us because they hadn't done any bigger deals. They had quite a number of deals under their belt, had started small and grown exponentially, as we advise a lot of people to do. And when they got to the point that they didn't have enough money, enough network and experience, they came to us and we helped them sponsor that deal. So I just want to use that as an example of what we're trying to do to help everybody that's on the platform. And it's available for anyone. If you're interested, just go visit thegobnetwork.com. And we're extremely proud to be affiliated with Daryl and this meetup and have them as part of the GOB network and one of our founding members. Thank you, Daryl.
I'm always fascinated about IRAs and 401ks and everything. And I was introduced to Miss Reneika Lightbourne, and she runs the AdvantaIRA membership. So Miss Reneika, can you hear me?
Yes, I sure can. How are you, Daryl?
Fantastic. All right. So I would like, please introduce yourself and tell everyone about you, and then go ahead and go right into your presentation. And you do have shared capabilities.
Wonderful. Thank you. Just bear with me. Let me pull it up. I will share my screen. Let me know if you can see my slides.
Yes.
Okay. So happy Valentine's, everyone. Thank you, Daryl. Thank you, GOB, for allowing AdvantaIRA to present and knowledge share with your audience today. I'm looking forward to just, engaging and interacting with all of you. So today we're going to be talking about using self-directed IRAs or 401ks or solo 401ks to invest in real estate, specifically commercial real estate, as that's your forte. Just a little background on me. I've been with Advanta as an employee since 2019 as a business development specialist. but I'm also an AdvantaIRA client. I've been a client for about since about maybe 2015 or 16. So self-direction is something that I personally and actively do. If you want to, do a one-on-one consultation or talk through your scenario, you can reach out to me via email. You can give me a call or go to AdvantaIRA.com to schedule that consultation. So just a little housekeeping before we get going. The information that I'm going to present today is just more so for educational purposes. As you guys know, with any investment, you want to do your due diligence. You want to make sure that you're consulting with your professional teams. Just a little history about Advanta and who we are. Again, I'm an employee of Advanta, but we've been in business for about nearly 20 years now as one of the leading self-directed IRA administrators in the business. We work with, individual clients and investment providers like yourself looking to use qualified retirement accounts to invest in alternative assets. We have a little over $2 billion under administration. Our focus is making sure that we provide our clients high quality concierge style service. And then, of course, our educational platform is second to none. We do guest speaking events such as this, but we also have internal events, which I'm actually hosting one right at the top of the hour. So if you have questions and I don't get to all of it, you're welcome to reach out to me. Just quick takeaways: if this is a new concept for you, just know that any IRA or former employer plan, like a 401k or a 403b or a TSP, qualifies to be self-directed. You choose the investment that works best for you. In this case, it's commercial real estate. And then, of course, just know that if your IRA or your 401k is involved in any investment, the income from that is it flows back into the retirement account. And if there's any expenses, it's paid out of the retirement account. So if you've never heard of it, just know that the main reason is because banks and brokerage firms, their business model is stocks and bonds. But in reality, the IRS say you can use your IRA funds to invest in a long list of different things, which includes real estate. So I think last year when I looked at the numbers, it was about $32 trillion that's sitting in retirement accounts. And of that, less than 4% is actually truly self-directed, meaning it's invested in something other than stocks and bonds. So for you guys as commercial real estate investors or syndicators, this is a great opportunity for you to kind of tap into that resource to raise funds for your next deal. So exactly what is a self-directed IRA or self-directed solo 401k? It just simply means that the account owner is going to have complete control over their retirement funds. They get to diversify. They get to decide what is it that they want to invest in. And I'll just touch on a couple of them. Obviously, commercial real estate is included, whether it's a storage unit or an apartment complex or an office building. The list goes on and on in terms of what's on the table for you. You can also use IRA funds or 401k funds to invest in notes and mortgages, precious metals, oil and gas, and so forth. So why do people choose to self-direct? This is typically a question I get when I do like an intro call. There's many different reasons, but I'll just touch on 3 of them. One, it's a new source of capital for you. So if someone has an old 401k from a previous employer, or they have an existing IRA, instead of taking out a bank loan or tapping into savings, they can elect to move those funds over to make their investment. Or if you're like an investment provider, you're about to purchase a 300 unit apartment, you can kind of work with your existing investor database, or you can market out there to people who have retirement accounts but don't know that they can actually use these funds to invest. And then, of course, the ups and downs in the stock market. No one can ever, time the market, but something overseas can be impacting the stock market here. Whereas with self-direction, specifically real estate, we know it's always going to retain some value. People are always going to need a place to live. So it's a great vehicle. We see a lot of real estate investors using self-direction just to kind of hedge against the stock market. And then, of course, the tax benefits, having those incomes, those rents, those dividends flow back into your retirement account, tax-free or tax-deferred, depending on the type of account that you have. In terms of the different types of accounts that can be self-directed, it's the ones that you're already familiar with. When you go to the IRS website, there's nothing that's called a self-directed. It's just more so terminology-wise industry, just to kind of differentiate from, traditional stocks and bonds. But IRAs are traditional IRAs, meaning pre-tax or tax deferred, where you get the tax break up front. You pay taxes later once you take it out at retirement. And then, of course, a Roth IRA is after-tax dollars, meaning you elect to pay the taxes now, grow the account over time. As long as you've had that Roth IRA for 5 years and you're 59 and a half, which is retirement age according to the IRS, when you pull those funds out, it's tax-free. So IRAs are for individuals as long as you have earned income. And then, of course, for entrepreneurs, business owners, a lot of real estate investors like yourself really like SEP, simples, and solo 401ks. Solo 401ks have a lot of flexibility. You have higher contribution limits. You just have a little bit more wiggle room when it comes to individual pay. So if you want to, again, do a deeper dive, feel free to reach out to me and we can hone in on that. Some lesser or smaller accounts that can also be self-directed are educational savings accounts. So if you have kids or grandkids or nieces and nephews, you can use those funds to pay for those educational expenses. And then, of course, HSAs to cover medical related expenses. As long as you have a high deductible insurance plan, you can certainly self-direct. So for instance, you can use one of your retirement accounts or multiple retirement accounts to lend or to participate in the deal. And I'll give you some examples in a later slide. And then, of course, again, any former employer plan, like an old 401k, 403b, or TSP type plan, can be self-directed. So just to look at the contribution limits, there's a couple ways that you can fund your account. One of them is an annual contribution. So for 2023, we've seen the increase, it bumped up just a little. So for a traditional or Roth IRA, if you're under the age of 50, you can put in $6,500. If you're over 50, you can put in $7,500. And then also with the Secure Act 2.0, they just recently referenced that in 2025, if you're between the ages of 60 and 65, you can actually contribute an additional $10,000 a year. For solo 401ks, you get to contribute twice essentially. You get to contribute as the employee, but also match as the employer. And when you combine the two, you can possibly put up to $66,000 in a solo 401k. And then for ESAs, you can put in $2,000 per year per child. For HSA, if you have, again, having a high deductible plan, as an individual, you can put in $3,850. If you have a family plan, you can contribute $7,750. Also with an HSA, if you're over the age of 55, you have an additional catch-up. In addition to funding your account by making an annual cash contribution, as long as you have earned income, you can also transfer from an existing IRA. So let's just say you have an IRA at Charles Schwab or Fidelity or another brokerage firm. You can move as much or as little as you want to or need to make that investment. There's no tax liabilities for you to do that. Or if you have an old 401k, again, a lot of times we leave jobs and we also leave those plans just sitting idle. You can elect to move those funds, or you can, again, you have clients who've invested with you in the past, maybe circle back to let them know, like, hey, if you have an old 401k, this is just another avenue for them to invest in one of your deals. Again, just to kind of recap on real estate is, pretty broad spectrum, but I know you guys are solely on related to commercial. Again, office space, industrial parks, retail spaces, storage units, the list goes on and on. You have syndications, you have multifamily projects, land. It's pretty much near limitless in terms of what's on the table. If you're a paper investor, you can do notes and mortgages, tax liens, joint ventures in terms of you can do option contracts or wholesaling, accounts receivable. So the list is pretty comprehensive when it comes to what you can invest in. I do want to touch on a few rules and restrictions in terms of what you can't do. So the only two investments, well, there's three, but mainly for investors, there's only two investments you cannot purchase in your IRA. That's life insurance and collectibles. Collectibles being anything like antique art, wine, stamps, anything of that nature. Again, outside of that, everything else is on the table for you. And S Corp, but it's more so related to S Corps in terms of not being able to use your IRA to invest in S Corps. Life insurance collectibles, straightforward. The other major restriction, and this is typically where we get most of our questions, is who the IRA is not allowed to transact with. And the IRA is not allowed to transact with someone who's considered a disqualified person. A disqualified person in this case would be you as the account owner, your spouse, any lineal ascendants or descendants, meaning parents, grandparents, children, grandchildren, any spouses of your children or grandchildren, but also any business or entity that's owned or controlled by a disqualified person. So for simplicity reason, just think of it like your IRA or your 401k can't be on the opposite side of the table. So if you own 123 Main Street today, you can't sell it to your IRA, or you can't take money from your spouse IRA to invest in one of your syndication projects if you're controlling that deal. So just be mindful of that. Also, too, if your IRA is involved in that investment, you can't do any of the sweat equity. So the IRS is not beating down your door to see if you're the one that's mowing the lawn. But I tell clients, if you know the rules, you want to follow it. You can oversee the project. You get to decide what needs to get done, but you can't physically, or no other disqualified person can't do any of the work. So if your son has a contracting business and you just bought a 50-unit apartment complex, well, you can't hire, if your IRA or 401k purchased that, you can't hire your son out to do that particular renovation. You can certainly hire it out to a non-disqualified person like a cousin or a brother, or a third-party company. Just be mindful of those few restrictions. When it comes to self-direction and a whole, just know that it not only allows you to invest in what you know, but also whom you know. The person on this call could be someone that you can do a deal with, or someone in your existing network. You just want to be mindful in terms of how you structure the deal. Going back to prohibited or disqualified persons, the IRS, does allow your IRA to partner with anyone. That includes yourself, that includes your spouse, or any other disqualified person. Meaning, let's just say you wanted to buy, a 20-unit apartment complex. Your IRA puts in money, your spouse IRA puts in money, your parents puts in money. That's perfectly fine if you're both sitting on the same side of the table as buyers. It only becomes prohibited if your IRA is on the opposite side in terms of buying, selling, borrow, lending. But you can certainly partner, you can certainly JV with anyone when it comes to retirement funds. So just kind of go through, before I get through the case studies, just to be mindful of when you use retirement funds, whether it's IRA or 401k, you don't want to take the funds out of the actual retirement account itself. You want to make sure it stays within that tax sheltered IRA or 401k. So for instance, if you have a 401k, if you take money out of that 401k to then go out and make that purchase to buy that apartment complex, just know that you're potentially subjecting yourself to taxes, meaning early withdrawal penalties, but also too getting the actual benefit of keeping the funds in the retirement account, where you're not subject to any capital gains when you sell the property. So for example, if you have a client that has $100,000 in the IRA and they don't know that they can keep the funds in a retirement account to buy that real estate property, they take the cash out, then of course, if they take the cash out, they're going to be hit with early withdrawal penalty, but also too, when they do sell up that investment property, they're now subject to capital gains. If you were to make that same purchase in your retirement account, meaning keep the funds in the IRA or the 401k, the IRA is the actual purchaser of that property. You're not subject to any early withdrawal penalties. When you sell that property, all of the profits, the proceeds flow back into that retirement account. Some things to keep in mind when your IRA or 401k is involved. Just know that if the funds are coming from the retirement account, it's actually going to be is going to be titled in the name of the IRA. So for example, it'll show that AdvantaIRA FBO, which is for benefit of John Smith's IRA, is actually purchasing this apartment complex or this land or this particular property. If the IRA is the only party involved, meaning if the IRA is the only person that's putting in funds, then of course all of the profits have to flow back into the retirement account. Again, you can partner with the IRA, meaning the IRA puts in funds, you put in money. Then, of course, based on the percentage of ownership, based on however much the retirement account puts in, that percentage will flow back into the IRA. So, for example, 123 Main Street's 100,000. The IRA put in 50% of the money, 50,000. Well, it's going to get back 50% of the profits when you sell the property, or 50% of the rental income, and then, of course, it's going to be responsible for paying 50% of the expenses, so whether that's property taxes or you got to pay a contractor. Then, of course, the IRA is responsible for its part, its share in the expenses. Just bear with me one moment. So when it comes to paying bills with the retirement account, there's two ways you can make investments in your IRA. And I'll give an example of checkbook control feature in a later case study. You can do it directly through the IRA or indirectly through an LLC. Directly through the IRA is you're telling Advanta to do X, Y, Z, meaning, hey, Advanta, send the money to a closing agent or closing attorney. Advanta, here's this invoice, this bill, pay it on behalf of my IRA. With self-direction, you're always in control. No money leaves your account until you say it does. Once you provide us an invoice or some other expense, we pay it based on your direction. Anytime money is deposited into your account, get an email notification of that. But also, too, just know that no money leave your account until you give explicit consent to do so, and you'll have access to an online portal with us. For property management, you don't have to have a property management. Obviously, with apartment complexes, it makes it that much easier. The property manager can handle everything, and of course, whatever the difference is in terms of the income that needs to that's left over after all of the expenses are covered, it'll be sent back to Advanta to be deposited into your account. Again, with the maintenance and the upkeep, you can't do any of the sweat equity. You can't, you're not supposed to be doing the one that's, doing any of the fixing or the upkeep on the property. You have to hire it out to a third party. It can't be a property management company that you personally own or have a vested interest in, or a maintenance company or contracting company that any other disqualified person owns or controls. So I do want to take a look at a couple case studies just to kind of give you an example of how it typically flows, whether you're an investment provider or you're an investor who's interested in using retirement funds to purchase or invest in syndications. So in this case, we have Jane and Randy. Jane has $100,000 in her IRA with Vanguard. Jane meets Randy. He's an investment provider. He's part of the GOB network, and apartment complex is what he does in terms of as a syndicator or an investment provider. So it's Jane's responsibility to do her due diligence, make sure she's comfortable that okay, she's checked out Randy's work, his history, projects that he's done in the past. Randy's going to, if she decides to invest with him, Randy's going to provide her with the subscription documents, meaning show that her IRA is going to the documents needed for her IRA to complete. Jane is not going to fill it out on behalf of her IRA. That's where Advanta comes in as the administrator, as the custodian. First and foremost, though, she will have to open up an account with us, fill out the paperwork, get her account open within 24 to 48 hours. In this case, it's going to be a transfer from her existing IRA with Vanguard. No tax liabilities for her to do that. Advanta will submit that request over to Vanguard on her behalf, get those funds moved over. And then, of course, Jane will give us permission to then send the money from her IRA over to Randy to make the investment on behalf of her retirement account. In this case, again, it's going to show that Advanta IRA, Jane Smith's IRA, 1, 2, 3 is actually part of this private placement or an investor in this particular project. And then, of course, moving forward, let's just say Randy is sending funds back on a quarterly basis, annual basis, or at the end of the project, whether it's 3 years or 5 years. He would then send the funds back to Advanta to be deposited into Jane's account. Jane is not accounting for those gains when she does her taxes yearly. It's actually just flowing back into her retirement account, tax-free or tax deferred, depending if she has a traditional or a Roth IRA. Okay, so in case study number 2, we have just JVing or partnering on a deal. It doesn't necessarily have to be an apartment or a commercial unit. I mean, it could be like a storage unit. We have a lot of clients that are actively involved in storage units. So in this particular case, we have Paul and Linda. They both have retirement funds, and they decide, they want to invest in real estate. They're both going to take out $100,000 from their respective accounts. They have to go out and find the property to invest in, just because Advanta, we have a list of investments for clients to choose from. They tap into their network. They found a property. In this case, it's a single family residential unit. They decide that they're going to purchase it for about $150,000. They're going to put in $20,000 just to kind of get it rent ready, and they've done their due diligence on the area. They feel comfortable that they can get $1,500 a month. In this case, both Paul and Linda would have to go through the process of opening up their account with us, funding their account with us. Again, they find the property. They work with their Advanta account manager to, put in that purchase authorization. Advanta will then work with their closing agent, closing attorney to then send the funds where it needs to go. And then, of course, moving forward, Advanta, as the custodian, as the administrator, will receive all of those documents on behalf, like the documents showing that the IRA is the actual owner of the property. And then, of course, based on Jane's and Paul's direction, Advanta will then pay any bills or any expenses. Like, for instance, they have the upkeep, the $20,000 in repairs. Advanta will pay that on their behalf, on the IRA's behalf. And then, of course, in this scenario, they're both equal partners. They decided to put, 50% each. So it'll be AdvantaIRA FBO, Paul's IRA account number as 50% interest owner in that property. And then, of course, Linda's IRA for the other 50%. The percentage of ownership, again, is just based on whatever each IRA puts in. So if Paul's IRA had put in 80%, then Paul's IRA is going to receive 80% of the profits, but also be responsible for 80% of the expenses. In this case, Paul and Linda are just, they're not spouse, they're not, any disqualified persons, they're just, friends or business partners. So if Paul wanted to exit and sell the rest, sell his shares to Linda, he can do that. Whereas if Paul and Linda were, husband and wife, and one of them wanted to exit a deal, they can't sell it to each other just because they're now going to be on the opposite side of the table, which will then make it a prohibited transaction. And then the last case study I do want to touch on is what's called checkbook control, or sometimes it's referred to as an LLC IRA. This is typically for more active or sophisticated investors who are wheeling and dealing. Obviously, commercial units, apartment complexes, tax lien investors, fix and flippers. Checkbook control is typically the one that gives you direct control over the funds, meaning if you needed to put in an offer, you have the ability to write a check, pay a bill, sign a contract. You don't have to reach out to Advanta to send the funds where it needs to go. You have complete control of that. The rules for checkbook control are still the same, though. Any money leaving that LLC's bank account, and I'll explain that scenario, is for, it's for the returns. Any money leaving the bank account is still for your retirement account. Any money coming out, like for expenses, is related to the 401k or the IRA. You don't want to commingle any funds. So the process for this is pretty straightforward. Let's say Joe, he wants to do checkbook control feature. First, he'll go through the process of opening up his account with us, filling out the paperwork. We'll get his account funded, whether it's going to be a transfer from an existing IRA or a rollover from old 403B. And then, of course, we get his account open within 24 to 48 hours. The next step, because he wants to use checkbook control, Advanta doesn't assist with setting up the LLC. Joe can do it himself if he's comfortable, or consult with her CPA or attorney to have them assist with it. But he essentially can open up an LLC in whatever state he chooses to. In this case, he's going to open it up in the state of Georgia. He decides what he wants to name that LLC. So it's going to be a brand new LLC, not one that he personally or currently owns, but it's going to be brand new. And he lists himself as manager. And as the manager, he has the authority to write a check, pay a bill, sign a contract. He will also draft an operating agreement document. That operating agreement document is going to show that the IRA is the owner. So that lets the IRS know when this LLC goes out and buy apartment 123, don't come after me to try to tax me. It's owned by my retirement account, which is tax sheltered. Advanta, as the administrator, as the custodian, signs that operating agreement document. Ultimately, before any money moves, Joe still have to give his consent. He does. Advanta will then issue the check. The funds that's sitting in his account with us temporarily will issue that check in the name of his LLC that's owned by his retirement account. Give him that check. He goes to whichever bank he wants to bank with, whether it's going to be a big bank, small bank. He'll go and open up a checking account for that LLC. He has the authority to do it because he's the manager. Deposit those funds, and now he literally controls the funds for his retirement account. And now when he's ready to purchase or do a deal, he can just send the funds where it needs to go. He can sign all of the closing documents. He can pay the contractors. The main thing that you don't want to do is don't get a credit card or a line of credit. You own your retirement account, yes. You control your retirement account, yes. But you have to think of it as its own separate person. its own separate entity. It's for later. It's for when you retire. So you can't get a credit card. However, for real estate investors, especially for commercial real estate, you can use loan, you can use leverage, but it has to be a very specific type of loan. It has to be a non-recourse loan anytime your IRA or your 401k is involved. Non-recourse just simply means that you, as the account owner, you're not personally guaranteeing that loan. It's going to be the IRA or the 401k that's taking out that loan. The non-recourse lender is not looking at your personal credit history or anything like that. They're just looking at the investment property. As the loan is repaid in an IRA scenario, it's subject to what's called UDFI tax. So in an IRA, UDFI tax. Solo 401k is not subject to that UDFI tax, and I'll give you the example in both of them. But just know that you have to use non-recourse loan. So for example, you have an IRA and you want to use loan or leverage to purchase property. Even if you had all of the money, you just wanted to buy multiple properties, so you don't want to tie all of your funds up in one property. You can, let's just say you put down a down payment of $30,000, you take out a non-recourse loan for $70,000, you fix that property up and you sell it in an IRA, 30% flows back into your IRA because that's how much the IRA puts down. However, the other 70% would be subject to UDFI tax, unrelated debt finance income tax. Obviously, you can work with a really good CPA to try to lower that UDFI tax for you, or as you repay that loan, as the IRA repays that loan, that UDFI tax goes away. Specifically for real estate investors like yourself, you tend to lean more towards the solo 401k because again, UDFI tax doesn't apply. So for example, property's 100,000, your IRA put down 30,000, take out a non-recourse loan for the remaining 70,000, you fix that property up and you sell it, 100% of that profit flows back into the solo 401k. So that's just something to be mindful of when it comes to IRAs and solo 401ks. And then of course, for Joe, moving forward, he can just essentially, rinse and repeat in terms of, doing his next deal. Any money coming in from those rental incomes flows back into that retirement account. Also to that LLC, it's considered a disregarded entity. It's not something that you file taxes on. At the end of each year, Advanta, as the administrator, as the custodian, will ask you to fill out what's called a fair market value and FMV form. And then of course, we report that on the back end to the IRS. So you don't have to, you just have to maintain that LLC with the state, make sure it's still active, but you don't actually file any taxes on that LLC itself. And just to, before I close it out and open it up for questions, just know that Advanta, we do weekly webinars. I'm actually about to do one in 15 minutes. We also have something what's called Pitch, Promote, Prosper. It's an open network platform to where you can come on and say, hey, deals that you have listed, or if you're looking for potential investors. We don't endorse any particular products. We always encourage everybody to do their own due diligence, but we have clients that's on that call that have money that's sitting that they may be looking for the next investment, or you can be investment providers saying, hey, it's almost like a haves and wants. And we do that every other Friday. So you can, again, check out our website. All of our webinars are recorded. It's on our YouTube channel, but also on our video library. And then, of course, when someone's ready to get started with us, just to kind of recap, the process is pretty straightforward. We've streamlined that in 3 simple steps. First, fill out the paperwork to open your account. We pair you up with a dedicated account manager. We'll walk you through that process. Step 2 is funding. Again, you can do a combination of transfer, annual contribution, or rollovers from an old employer plan. And then finally, step 3 is invest. In this case, it's investments related to commercial properties. And with that, I will open it up for a couple of questions. And I will stop sharing as well.
All right. Thank you very much. Thank you very much. So, any questions?
I have a question, if you don't mind, Daryl.
Sure, go right ahead.
First of all, I just want to thank you for inviting me to this call. It's been amazing so far. I can't wait to join more. And I really appreciate the presentation that Reneika just did. It was something that I need to become very much so more familiar with on behalf of myself and my investors. And I wanted to ask a question related to my own situation. So I am currently a W-2 employee and I have a business. So is it possible for me to actually have two types of IRAs, I guess, maybe the traditional and the SEP, and make maximum contributions in both?
So a great question. Believe it or not, yes, you can participate in your W-2's 401k plan. And also if you have your own business, you can have your own solo 401k, or you can do a SEP. Anyone is eligible for an IRA as long as you have earned income. But for you as a business owner, you would definitely want to look at the SEP Simples or solo 401k. The only thing I would tell you to keep in mind if you decide to do a solo 401k is if you max out at your W-2 job. So right now for 2023, as an employee, you can put 22,500. So if you max out at your W-2 and you open up a solo 401k, you can't make any contributions on the employee side of your solo 401k because you've met that threshold. But you can certainly match up to 25% as the owner of your own business.
That makes sense. Okay. And I'm looking forward to getting your contact information. Actually, I just sent you a Facebook message. We're already friends. So I want to make a personal appointment.
Let me, what I can do is also put my contact information in the chat as well. Just bear with me.
Yeah, please do that. Yeah, definitely. Ms. Stephanie, go ahead and ask your question.
Reneika, great presentation. My question is the fees that are associated with Advanta, does that come out of the IRA, the SEP or IRA account?
Great question. So Advanta, we're not the highest in the industry in terms of price, but we're not the lowest. Our focus is quality service. But yes, you can have the fees deducted directly from the account itself, or you can place a card and file to account for those fees. But there's really three main fees to be concerned about. There's an opening fee of $50, 50. There's a transaction fee when you buy or sell. So if it's, a syndication, like a paper investment, it's a $95 transaction fee. If you're buying physical, tangible real estate, like an apartment or, a single property, it's a $145 transaction fee because we're working with your closing agent or closing attorney. And then on an annual basis, we still have to do all of the record keeping, all of the IRS reporting. We give you two options. Typically, option one is a flat fee of $295 a year if it's just a paper investment like a syndication, or if you're buying physical, tangible real estate, meaning your IRA owns 123 Main Street or your IRA owns this storage unit, then it's a $345 transaction fee. One way to kind of help minimize the cost, if you do the LLC feature, you can have as many investments in that LLC as you want and not pay us a transaction fee every time. So.
Fantastic. Fantastic. Any other question before we, can't. All right, listen. Ms. Reneika has posted her information in the Slack, in the chat channel. So if you have any questions, please reach out to her so that she can help you or answer any questions, all right? Ms. Reneika, I know you have to run, but I want to say thank you very much for coming and spending your time here and explaining about the IRA. I really want to say thank you. Thank you very much for coming.
Thank you as well. I hope you guys have a great rest of your day, and feel free to reach out to me. You can send me an email or reach out to me on LinkedIn as well. Have a great rest of the day, everyone.
Thank you. Thank you very much. All right.